What does capital gains tax look like moving forward? Hi, I'm Kimberly Chapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. We've seen some changes in capital gains tax, so we're going to dive into the numbers today and have a chat through exactly how we calculate our capital gains tax for a basic rate taxpayer, a higher rate taxpayer, to ensure that we know exactly what is happening and how it fits together. Let's jump into our example, and today we're going to look at a property that was bought for $150,000 with some stamp duty costs of $4,500, legal fees of $1,000, and they've had some improvements of $15,500. They've actually then gone and sold that property for £200,000 and they have got some sales costs of £3,000. So that's what has happened with our property side of things. But this person has also sold some stocks, shares, cryptocurrency, you name it, but it has created a capital gains tax transaction. So we've also got a purchase price here of $500. We're going to ignore stamp duty as it'll be minimum at the rates that apply to any of those types of purchases. And we've got a sold price of $10,000 and some fees for selling that asset of $250,000. So what we're going to do is we're going to dive into a tax calculation where our earnings are $25,000. And then after that, we are going to look at our same example with our same numbers, but how it is impacted by earning $55,000. So you may see there, one is going to hopefully just about give us a basic rate tax calculation, and the other is going to give us our higher rate tax calculation. Now we've got all our key numbers, let us start on our calculations. First, we'll look at our calculation if our income is $25,000. So this becomes relevant when we get to the capital gains tax side, but let's start with our capital gains tax calculation. So we've got our proceeds of our sale of our property, and this is our $200,000. We are going to take off our property purchase of £150,000. We also can take off our stamp duty of $4,500, and we can take off our legals, sales costs, and our improvements. So we've got $1,000 of legal costs, $3,000 of sales costs, and we've got $15,500 of improvements to give us a gain for tax purposes of $26,000. Now, as individuals, we all have our capital gains tax allowance. So assuming that this hasn't been used yet, because this is the first disposal in a tax period, we also have our annual allowance, which is at $3,000. So this gives us a taxable gain of $23,000. So now the question is, what have you earned in that tax year? So this is quite a key question. So we're saying here we've earned $25,000, which means of our $50,270 basic rate band, we have used $25,000, which means on that basis, we still have $25,270 of our basic rate band. So our taxable gain at this point is going to be at 18% because we are basic rate banded. So we have 23,000 at 18%, which equals 4,140. Now this will be due to be completed on a capital gains tax return within 60 days of your disposal, and you have to pay the tax that is calculated at this point in time on it, which is your 4,140. Now, in our example, we've also got our other gain. So we need to look at our other gain where we've got proceeds of 10,000. We've got costs of 500 and 250, which gives us a gain of 9,250. Now, if we look at our gain of 9,250, have we got an annual allowance left? And our answer here is no, because we have used our annual allowance over here, which therefore means we are going to be taxed on all of this amount. Now, we've already used of our 25,270 that we were left with, we've used 23,000. So that means of our basic rate band, we have got 2,270. So that means we can be taxed at the new rates which happened in the October budget at 18% now on 2,270, which equates to 408.60, and the remaining balance of 9,250 take away our 2,270, which equals 6,980, will be taxed at 24%, which equates to 1,675.20. So our total tax to pay on this is going to be 2,083.80. Now, because that's not a residential property, that is not actually going to be taxed until you complete your tax return. And when you do your tax return for that tax year, so if, for example, we do the 2023-24 tax year, that means the tax return is going to be due by January 2025, and that is when the tax for any additional capital gains tax is going to be due. Historically, the rates were 10 and 20%. That has now increased to 18 and 24% for other capital gains. The property side of things is the same as it has been at 18 and 24%. So overall, for this individual, we are going to have 2,083.80 plus our 4,140, which will have been paid earlier in the year to pay off the tax within 60 days. But they will have paid 6,223.80 of capital gains tax during the period, and this then will get checked when the personal tax return is done, depending if that income level of 25,000 changes or not. If it's exactly 25,000, everything we've just done there is fine. If they suddenly find that they get a bonus at their work, or their rents go up, or whatever that 25,000 is made up of changes, then this will have an impact on this calculation of what can be and cannot be used. So it is very much these areas which I'm just highlighting in green that will be affected depending on how that 50,270 is used. And if it's used for any income, then the capital gains tax will get pushed into the higher brackets of tax. So as you can see, even though this is a basic rate taxpayer, because of the capital gains, we have got some which is at the 24% rate. Let us have a look at our higher rate tax calculation. So this is where the individual is going to be paying at higher rate for the tax. So let's start with our property side of things. So let's include our proceeds of 200,000 again. We've got our property cost at 150,000 of what we originally paid for it. We have our stamp duty, which is at 4,500. Our legals, which will be at £1,000. Our sales costs, which are at £3,000, and our improvements, which are at 15,500, which give us a nice healthy gain of 26,000. Now this is our gain, as we said in our previous calculation, before our annual allowance. So we do have an annual allowance, and that is still at 3,000. So our actual taxable gain that we are working with is going to be at 23,000. And what we've said in our example here is this person earns 55,000 from whatever sources that they have. So that means that they are going to automatically be in the higher rates of tax for capital gains, which means our 23,000 is going to be times by 24%, which is our current tax rate, to give us a tax chargeable, a tax to pay of 5,520. Now, this will be payable within 60 days and will be reportable on your capital gains tax return. So something just to make sure you're aware of when you have sold a property on that period. And the date that you complete is the day that the clock starts ticking, that you need to do the calculation, you need to do the capital gains tax return, and then you need to pay the tax payable with the reference that is provided with the return that is completed. Now, in the same tax year for our example, we're also going to do a sale of some crypto or some stocks and shares or anything else that might create a capital gains tax charge. So in this period, we have got proceeds of 10,000. We've also got our purchase price, which is only £500. We're going to ignore stamp duty because it will be minimal for us, and we are going to include some fees for the sale of the property of £250. So on that basis, again, as we had before, we've got 9,250 gain. Now, on the assumption we've already used our annual allowance over here, we are now at a position where we are again going to be charged on the full amount that we've made at the 24%, which gives us a tax payable of 2,220 to pay. Now, the difference between the two calculations are this tax rate has recently gone up in the November 2024 budget, which means this is higher than it will have been in the past. This tax is actually only payable when you complete your tax return. So if the tax is payable based on when the video is released, that will be in the 24-25 tax period, which means this would be payable in January 2026 when the April 2025 tax return is completed. So you have got time for this one. There is no 60-day time limit on it, which means that you have got some time before you have to pay this balance. So the total capital gains tax that will have been paid in this tax year will be £7,740. Now, when you do the capital gains tax return for your property sale, you will then need to put it on your tax return, because if your income is different, maybe when you did your tax return, you thought that you were only going to earn 40,000, and when you came to complete it at the end of the tax year, it was 55,000. You may not have paid enough capital gains tax. If you thought you were going to earn 60,000 and actually you only earned 40,000, then you may have overpaid on tax in the tax period. So there is an element that it might shift when you do your tax return just to a little bit, depending on what your earnings was or is going to be. But this hopefully gives you an idea of exactly how the tax side of things will work. The key change that we've seen in the budget in November 2024 is the increase in tax rates. So those additional capital gains, for example, the stocks, shares, crypto, antique furniture, antique anything that gets a gain over a certain amount, will all fall into this category. So for this, it was 10% and 20%. That's now increased to the 18% and the 24%. So it's just something to be aware of so that you are aware of the additional tax liability that will hit on your next tax return. As you can see, from a property point of view, there hasn't been too many changes. However, for those that have other investments, maybe a few stocks and shares and things like this, there has been a slight impact on the capital gains tax that is now being paid on them. Hopefully today you've got a good idea of how capital gains tax is working for you and your disposals moving forward from 2024 through 2025 and into the future. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing. Let's make tax less taxing.